The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Traditionally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks, and we are down a little bit in the Dow right now. We were down about 100. We came back to be almost unchanged, which, given the fact that the market has held these major fib points since early June just absolutely perfectly. I put the chart up for the Bradley model, and basically it is showing that we have a downtrend that should have started around July 8th, which was the anniversary date of the low of the stock market in 1932 when the Dow hit 42. And it says that we should be down into late December, early January. And we should have one really good place to get short in early November if there is a reaction, but we'll have to wait and see. The real key here, folks, is to look at the June low. If you wanted to look at it in the Dow Jones Industrial Average, that comes in at 16,700. We're 237 points away from that, but if we take out 16,700, we're in big trouble because we'll be taking out the lows of the last 2 months, and it would have broken the back of this market, at least for the short term. Whether it has a rally or whether it's going to go straight down, nobody knows that. But there are some real serious things that are out there, technically speaking. I'm not talking about the things that you hear in the fundamentals about the airplanes that are being shot down and stuff like that. I'm just talking about the technical nature, of the market. Last week when we had that, week before last, when we had that 40% move in the VIX index in one day, and then Basil Chapman absolutely nailed it on the downside. He said it wouldn't get below 1141, and 1141 was the low on one day. The next day the low was 1142. And now it's trading up into the 13 area again. And here again, if we get above that level, above 13 and change, then that means we're probably getting ready for a pretty significant sell-off in stocks. We will get one, folks, because the market is so overbought, and there's so much complacency out there that, everybody wants to buy a 10% correction, but, and some people want to buy a 20% correction, but I really think we're looking at something a lot more sinister than that. But each time the market comes down, the low today in the Dow Jones Industrial Average was exactly 786 of the low we made back on June the 30th. So all of that is still lining up perfectly. The market has not turned down yet. I believe two levels in the Dow Jones are very important. The first is 16,800, and the second one would be 16,700. The second one, 16,700, would take out the lows of June, and that means you would have a 2-month reversal there, and usually you'll get a pretty substantial move. Now, the Bradley model is just a very good indication of what the stock market should do. It's certainly not perfect, but two things we know about it. The trading dates are very, very good. They're in the neighborhood of about 80%. In other words, as you come into one of these trading dates, the market has a tendency to make a pretty substantial move, either in an inverted market or a regular market, that there will be a key date that occurs on the Bradley date. The second thing we know about it is that once it starts to trend and follow what the forecast is supposed to be, it usually follows very, very nicely, like we've been following really nicely since February 3rd lows. We went right up into July, and now it says that we should be heading down into around the 15th of September. We have a little bit of a rally here, takes us into early November, and then we should have a really hard move down between November in January, if that's the way that it turns out. But so far, all it's done is hit some real key points in the stock market and held those points, and nothing really has made you think that the bull market is over, even though we have all of these indicators that tell us that we are extremely, overbought But, most of these people that are in the market have no idea what technical analysis is. That's either a good thing or a bad thing. I'm not sure which, but that's at least the way we're reading it right now. We're going to take a look now at the VIX index using the patterns and the Fibonacci numbers. Fortunately, they come very close to what Basil Chapman talks about. And the 786 retracement was exactly at that 1141 level. That was from the low we made back in July. Then we had the big run-up of 40% that came up to the 1530 level. And then the 786 retracement backstopped exactly at 1141 for 2 days. And so far today, we've had a move up, and then the market has been rallying from the lows, so the market has backed off. I agree with Basil that if we can get this VIX index somewhere around 1380 to 1400, then that's going to set up this next ABCD pattern that takes us to the 786, which would be up around 1620. Remember, this index hit 90 back during the too big to fail era, and I believe the banks have not done anything differently. All they've done is increase their leverage. And they're doing exactly the same thing they were doing before, because that's what brings in the money. So when this credit crunch comes, it's going to be a nasty one, and it's going to be worse than 2008. I believe that. I don't know what's going to cause it, but it's going to be worse. History says that that's what will happen, and I'm going to stick by that until proven wrong, which that could happen at any moment, because this market could make new highs without any trouble. Whatsoever. And as Basil pointed out, there are sectors, that are holding up, really well. And those are the ones that seem to be where everybody's putting their money. We're going to take a quick look here at the banking index, because this is what moves the money through these channels here. And as you can see, we've made a head and shoulders pattern. We haven't violated it yet. All we're doing now is making a 5-day retracement back from the high that was made back on June 30th. Then last week we completed a really nice ABCD pattern that took out the June lows, and then the market has been rallying for the last 6 days, and we're setting exactly at a 61% retracement of the highs we made, back in early July. So until that banking index gets above the 73 level, it looks to me like we still have more to go to the downside. But it is one of the indexes that trades relatively nicely with the Fibonacci numbers and the patterns that we use. There's an interesting thing happening in the news. I don't know if you folks are aware of it or not, but there's a class action lawsuit brought on by 3 anonymous traders against the Chicago Mercantile Exchange, saying that 40% or 50% of all of the trades that are done at the Chicago Mercantile Exchange are wash trades. In other words, there's a buyer and sellers doing the same trade at the same time. I do not believe that the Merc would be involved in something like that. They're talking about the people that are doing it are making $60 million a day. That seems like a lot of money in what's going on in the world. But if you take 60 million and you multiply that times 255, which is the number of trading days of the year, you only come up with $1.5 billion. That's not a lot of money anymore, folks. I mean, it's a lot of money to you and me, but in the financial markets, that's not a lot of money. If J.P. Morgan can, be fined 17 or 18 billion dollars, 1.5 million in profits is not that much. And frankly, I think they have more to lose with the integrity of the exchange of doing something like that. But it is a class action lawsuit brought by 3 anonymous traders. We don't know who they are as of yet. It's the old, going back to the Watergate thing, unknown source, deep throat or whatever it happens to be. But we'll have to wait and see if that happens. Frankly, I look at this high-frequency trading. It doesn't affect me very much because I'm not looking at 1-minute charts or tick charts and things like that. The patterns that we're looking at are still working beautifully. I haven't seen any indication that's anything different than any market that I've ever looked at. And, I looked at stuff that went back as far as 400 or 500 years ago where they had charts on it, and they really don't look any different. They all look the same. They might go a little higher than I predicted, but that happens all the time. But that's the main thing is the patterns are still there, the ratios are still there. There shouldn't be anything different this time because this is all natural law and it has nature behind it. So I don't think there's going to be any different. There will be a time where the market sells off, and it will sell off dramatically, because the margin debt is extremely high. The number of bulls are extremely high. And when they try to go to the door to get out, they're not going to be able to get out at the same high level. They're all going to be. Bernard Baruch said one of the greatest scams in the world in the stock market was to inflate something to a high price, and people will buy it all the way down. And I agree with that. We see that happen all the time, and it's happened to me once back in 1973, 74. So that's the thing that we're looking at. I noticed that today on CNBC there were two people that were coming on talking about not end of the world type scenarios, but potential market crashes. And I don't know who they were. One was named Mark Cook. He's a trader out of Ohio, and I don't know who the other one was. But there is one fellow who I really respect, and that's Bert Dolman of the Wellington Letter, and he is extremely bearish, and he's looking for a 2008 type market. And he wrote a book in 2007 about what was going to happen in 2008, and he was certainly spot on about that. Whether he'll be right again, I don't know. All I know is the technical factors that we're looking at when we're watching these markets move around have really been, very, very overbought in any situation. The one that we talked about last week, that we've gone 33 months since we've had a 10% correction, and that's only happened 5 times in history. Back in 2007, 1987 was before the big crash of October 19th of 87, and then we had one in the big correction from the bottom of the stock market that topped in 1937, and then the market went down into the war years of 1941-42, and then, of course, we had the top in 1929 on September 3rd. There's only 3 times in history when corporate profits are 10% above GDP. That was 1966. Market went down for 6 years after that, and then in 2007 we know what happened. And then the stock market capitalization as percent of GDP, which is Warren Buffett's measure of frothiness in the market, usually averages about 70%. In 2000 it was 150%. That was the dot-com bubble. 2007 was the real estate bubble. We were at 111%. And right now, in 2014, what we're calling a debt bubble is 127%. So we are certainly in this area. And when you add to this that the money market funds have the lowest level of funds available to buy stock since they've had since 1998, and when you stop and think that the folks that are buying are heavily leveraged, there's problems out there. Got the Dow down about 30, and the S&P down a couple, and the NASDAQ down 2. We'll be right back.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the signal box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Information about soybeans. Lou, are you there? I don't know if I've been able to pick him up or not. Evidently, we've lost Lou.
Hello,
we'll try to hold on. Oh, great.
Hello. Yeah.
You have a question about soybeans.
Yeah, soybeans. What direction do you think we're going to be going?
Well, we've been heading down for quite some time, and once we broke that 1240 level, I don't know if you were on the air when we had Rich Anderson, back in June, and he said that, if we broke that 1240 level in soybeans and the November beans, that we would looking at a much lower market, and it's dropped $10,000 a contract, and we've had a little bit of a bounce here. But to me, it looks like we're setting up a three drive to a bottom pattern that would be about 60 cents lower.
Oh, cool.
I'll put this into Tiger TV to let you folks take a look at it. But that's what it looks like to me. Is that we've had the first bottom formed a week or so ago, and we would have another one coming in at around the 1040 level. That would be down exactly $2 a bushel from the high that we had at the 61% retracement up at the 1240 level. So that's what I'm looking at. And if we get above, the 1150 area, then that's probably going to be a bottom for a while. But, this market is under a great deal of pressure, as is corn and wheat. But at least some of the selling has abated in all of those. They've had a little bit of a rallies, very minor, but at least they're bouncing a little bit.
Right. Okay. Keep my hat on.
Well, just keep an eye on it, because I think it'll be a pretty good buy if it gets down to that 1040 level, because that would be a really nice three drive to a bottom pattern, and that's one of my favorite patterns, because you know exactly, how much juice you have to squeeze in order to make a profit. So that's the whole thing to do, is to make sure that the juice is worth the squeeze.
Gotcha.
All right, Lou. Thanks for calling in, my friend. You bet.
Thank you.
Okay, I wanted to cover one other thing here in the stock market here that I think is relatively important and actually is related to the bond market, and that is, we've alluded to this before, and that is finally junk bonds have been losing their premium to the 30-year bond. In other words, the 30-year bond premium has increased over the junk bonds, as they should. It usually is a very wide premium, but got into historical lows. It's starting to widen out now. But the chart that I posted here into Tiger TV is the one from Lipper Analytical Services. It shows the money that's flowing out of junk bonds. So some people are getting a little bit scared about junk bonds, which they should. Whenever you see Spanish bonds, 30-year bonds selling at the same price as the bonds we have for U.S. Treasury, there's got to be, something's wrong. There's got to be something not correct if that's the case. Now, the overall stock market, let's just take a quick look at that, and we look at the New York Stock Exchange Index. And as you know, we made new highs in the S&P a week ago. And then we also made a new high in the NASDAQ that went up to the 1.618 expansion. But all during that time, we did not make a new high in the New York Stock Exchange Index. We got up to the exact 786 at 11,033. And today's low has been exactly a 61% retracement of the low that we made back on the 17th of July. So this is a real interest. It's also 786 of the low we made off of July 18th. So it's really interesting. The key figure here to look for is if we get below 10,880. That's equivalent to the Dow Jones going below 16,700. And usually if it does something like this, it'll do it very, very dramatically. In other words, it just won't go down there and, touch it a little bit. It'll go through it by 150 points or something like that, because this market is really top-heavy, folks, with people that are heavily margined, as we already know, and it has some really serious underpinnings that could be very, very disastrous. They haven't been as of yet, but that doesn't mean that history's not going to eventually say, yes, this is what's going to happen. The thing that I'm watching, of course, now is that the market is actually following the Bradley model relatively well, and so we want to be able to, watch it to see if it keeps following. But if we make new highs now in the Dow Jones Industrial Average, then I would have to say that, there's something is certainly wrong again, and it's probably going to go higher yet. If you want to see a market that's really bearish, one of the largest economies in the world, Germany, that stock market is already down 5% from its highs. It topped at around 10,000, and it's trading around 9,500, and it just doesn't have any friends. Every time it rallies a little bit, it gets hammered really badly. Hey, we got the Dow down, same as before, down about 33, S&P down a few, NASDAQ down a few, and we've got gold holding its own up $1.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Back, folks, and I posted the chart of Amazon just to show you the technical picture of Amazon, because it is really phenomenal how it moves against the normal things of fundamentals and makes these beautiful technical patterns. You can see the first ABCD pattern that occurred from October to November, caught the high up around 400. The next ABCD pattern, saw the bottom down there around 300. Then we had, just recently, last week, we had a 61% retracement of the high from January and a 786 from the high of March. And that came in exactly at the high at 365. And then there was bad earnings that came out, I guess, and the market gapped down and dropped down about 40 points, I believe, at the largest drop. And it stopped exactly to the exact penny of the 61% retracement from the May low, which telling us that there's strong support here in Amazon at this level. But if we get below 310, or actually 314, then this will truly be something to the downside. But this is why I like pattern recognition so much, and it doesn't work all the time, but nothing else does either. So, but when it does work, it really gives you an idea of what these markets are all about. I don't know anything about high frequency trading, which is about this lawsuit that's going on at the Merck, and I don't know what's going to happen with it, but I'm certainly going to be following it. On Thursday's show, we're going to have Rich Anderson on. He has some information about this that he's going to be able to share with us. Also, there's some interesting things happening in the live cattle market that Rich wants to share with us. And since we're on the subject of commodities, I wanted to alert you to something that could be happening. I don't know if it's going to happen, but it started, and that's the whole key to watch, and that's silver. It also pertains to gold. But we've made a perfect ABCD pattern at the exact 38% retracement at 12.40. We rallied about 40 cents an ounce from that level. We're still trading 18 cents above 12.40. What am I talking about? $20.40 an ounce and $20.80 an ounce. So it hit 20.40, rallied 40 cents to $20.80 an ounce. And as long as we can stay above this 20.40, this ABCD would be absolutely perfect. And if the silver does start up and we get above the $21 per ounce level, the target is $10,000 higher than that. And folks, that's the juice that's in the squeeze, because if you can make $10,000 by only risking $1,000, you've got something really positive, because you got the trend moving in your favor. You know exactly what your stop protection is going to be, and you know your profit objective is going to be at least $2 an ounce more than the the $1,000 at 20 cents an ounce that you're going to be able to risk on it. So we're watching this real closely, but we really need it to get above 2,100 to get it to move. And the same situations existing in the gold market. We need gold to get above the 320 level. It came down to the 50% retracement, whereas silver, for the first time in a long time, has been acting more bullish than gold. This has really been a long time since this has happened. But during this last sell-off, silver has held up extremely well. The only thing that prevents me from becoming wildly bullish is the fact that we've had virtually no change in any of the open interest or volume figures that we get from the CME. So you can't tell if there's any new buying, because there really isn't. There's people moving in and out of the markets, but these are just new people coming in and old people going out. There's no one that's coming in with a big commitment, to put the open interest figures, much higher. However, I will mention this. Much of the business that goes on in gold and silver is done in the cash market. It's not even done through the futures exchanges. So you've got to keep that in mind, that really is a very important thing. The gold-silver index itself also has a tremendously bullish pattern if it can hold the levels that we made just last Thursday. Oh, dear. This is not good. 1 second. The old computers are giving me a bad time again. Let me see if I can get this thing fixed up. Oh, gosh. I don't know why it does this to me. It's not going to do it. Shucks. I had it all. Wait a minute. I do have it. 1 second. If I can only... I am able to do it, hopefully. It should be right in here somewhere. Give me a second. There it is. I've got it. Hey, that's not too bad for a wild guess. There we go. We're going to show you the gold-silver index. And as you can see, we had a 2-week sell-off that had virtually a double bottom, almost at the 382. It could not even make a 382 retracement, whereas the silver was able to make the 382 retracement. Gold was only able to make the 50% retracement. And so if this is correct, the market's, basically down just a little bit today because of the profit taking in the rest of the market. But it really is holding at a really, really strong area. And if we can get this gold-silver index above 105, this thing is going to really take off. And we could really have a real fun market again in gold and silver, where we have these vertical moves that run like $150 in gold and $3-4 in silver, and those are really fun if you can get on board. But we really need silver to get above $21 an ounce, and we need gold to get above $1,335 an ounce for that to really occur. Whether this would be a flight to quality trade if the stock market sells off, I have no idea. Because when margin calls come, people start selling everything from bed sheets to bridal showers. So they just don't they don't hold any prisoners once the market comes down and they start asking for margin calls. I have personal experience from 1974, and it is not a good feeling to look at when you have something like this, really occur to give you a situation like that. That's not much fun to look at. Now, I wanted to show you one other chart with the commodities. I think it's important, and that is the fact that we have a situation in gasoline where we've been down for well over 5 weeks. Gas prices in the middle of the summer, when they should be going up, are going down. That's a very counter-cyclical move that usually is extremely bearish, and that could also be bearish to crude oil also. I've had a request to post the gold chart, and if you'll give me a second here, I'm pretty sure I have it here somewhere. But then again, it takes me a little bit of time to, shucks, I don't have it right here. I'll have to get it. Well, we will have to dig the gold chart out here and see if I can pull it up really quickly here. And we'll get a chart up in gold and see what it's doing. It's got a chance here. It's selling off just a little bit. It's down a few dollars today, but having no volatility is actually a pretty good thing here with the gold. But yeah, here we go. We've got a nice chart ready to go here on the gold. And as you can see, we pulled back to the 50% level here, and we haven't gone anywhere yet. And as long as we stay above that 1287, we've still got a chance here in the gold. The good part here is that we've been down for almost 3 weeks now in gold with virtually no correction. We came to a 50% correction in gold, 38% correction in silver, and those are positive things given the fact that we've come off some major bottoms here. So if gold takes off from here, it's got at least $100 an ounce in it, and the risk here is about $12 to $15 per ounce. So we want to watch it very closely. I think once gold can break above the 1335 level, we'd be looking at least 1435 as a minimum target. So that's $10,000. So if you can get in and only risk somewhere between $1,500 and $2,000, it would be a 5-to-1 risk-reward ratio, and that would be another one that would look really interesting. And it'll give you plenty of chances to buy it. It's not going to go. It's not going to go straight up. The only things that go straight up are the U.S. stock market, Hong Kong real estate, and the real estate in the United Kingdom. Those are the only ones that go straight up. Hong Kong prices, my wife Sarah told me today, we're still going higher. They have had a tiny back off during the month of May when they were having some of the demonstrations over there against China, but China put a stop to that, and so real estate prices are now starting to move up. I don't know if you folks know this or not, but I think there's almost 1,000 islands, if I'm not mistaken. Well, hundreds of them, I know for sure, around Hong Kong, and these little islands are habited by people that take the ferries in to Kowloon and Tsim Sha Tsui to work, and that's where the bulk of the people live. But these islands are getting very, very, inhabitable now. The place where my wife happens to be right now visiting relatives is right near the beach. They don't have an elevator in the town, and not all the houses there have electricity. They all have running water, but not all of them have electricity. So they go back pretty far. But this is also about 40 miles away from Hong Kong, out in the South China Sea. So it's a rather unique place where a lot of the older people go, to pass their days, to stay on the green side of the grass, and that's always an important thing to look at. We want to take a quick look here at the bond market, because I really believe that we are looking for higher interest rates in here. It doesn't appear that nothing's going to change that. And we're still seeing the Treasury bonds are gaining to the notes. The notes are by far the weakest, which tells us that rates are going to go. They are going to go higher. There is a possibility that if we can get the bonds to close above the 139 level, that we could get them to go to the 142, which is the 786 of that whole bear market that when we topped in the bonds up in the 160 area about a year and a half ago. So we've been in a really strong rally here since January. So we're 7 months into a rally. We're ready to, have a pretty good correction. And the notes are telling us they've already started down in the notes. And so it gives you an idea that this is a possibility that this is what we're looking at. Higher rates are on the way. I don't know what the Fed's going to do about it, but the marketplace is telling us that's what's happening. And the Fed cannot control interest rates worldwide. They can play games with what they're doing here now, with all the stuff that's happening with keeping the rates the same. But believe me, if they've made a mistake, and I know this is a giant experiment, this is going to be one of the biggest of all time. It'll make the one at long-term capital look like something from a Lego set, because it'll be really, really nasty. Because how do you unwind something that will not have another counterparty to buy it? That's going to be a real interesting thing to look at. If we take a look, and we'll do this again here, at the long-term chart here in the bonds, we'll just put this up here to show you where we are. This has really been a really nice market to look at over the years. We had the big top, and now what we're doing now is we're making, in fact, we've already completed this Gartley pattern, and from the high, and we should be getting ready to start down any moment now. We've tried a few times. It went up to the 382, which is also relatively negative. It took the market from January to July to only make a 382 retracement from the high we made back in 2012 in July. It topped on July 27th of, wow, that's amazing, isn't it? And today's the 28th. Yeah, the bonds topped on July 27th in 2012, and here we are, July 28th, 2014, and also at a very important FIB point. So this will be interesting if that almost makes that a head and shoulders pattern too, because the two shoulders are equal distance apart at the same price. Boy, that's going to be interesting here these next few days. It's a weekly chart that we're looking at here in the bonds, but it should be quite interesting here over the next few days and what happens with interest rates. And we'll know more as we get more news from some of these things. I haven't followed any of the news about what's happening with the planes that are shot down and what's going on. I just get a little bit overwhelming to me. So I took a break from all the news this week, and that's been a good thing, because I haven't had anybody call me to tell me that the end of the world is in sight, which it might be, but they haven't told me yet. So we'll see if this is going to be a big correction in the stock market or just a minor correction. I know most of you folks don't trade the DAX index, the German stock market, which is just like the German, it's the equivalent of the S&P 500, and that is one bearish chart, folks, let me tell you. Okay, we got the Dow down about 25. NASDAQ is flirting with unchanged, and S&P down a couple.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, folks, I'm back, and I've posted in the chart of the cash S&P 500, and I've tried to highlight it over the past month to show you that the channel line that we've had in this has been just absolutely spot on geometrically. We've made several A, B, C, D patterns. We made a 3-drive to a top pattern. We made a butterfly pattern. And as you can see, all of the lows that are there starting back in June, which is equivalent to that 16,700 in the Dow, that's the June low, have all been at Fibonacci numbers, including the low that we made today. The low that we made today was exactly a 61% retracement of the low we made on the 15th of July. So each one of these has held it. Now, when it breaks that trend line to the downside, that's known as a valid trend line. And the reason why it's valid, it's built on the Fibonacci numbers of the previous lows. In other words, each previous cycle low will either be a 618 or a 786 of the previous low, so that tells you that's what it is. And then in order to verify that it's geometrically correct, you clone the line, and you see that if you take it to the top side, you'll see that the top were also held together by either 1.27s or 1.618s. And that's what makes a perfect channel line what you have now. So this is basically a flag that you have going on here, a long-term one, of course, but the key to watch is the low of June the tenth, I believe, is the kilo. It's 16,700 in the Dow, and it's at 1936 in the S&P 500. So that's a little ways to go, but we're at a very critical level here. We've had some real important things happen, but the key this week to watch is the fact that the Bradley model has definitely started to turn down. The Dow Jones did not make a new high that last run when we made a new high in the S&P and we made a new high in the NASDAQ. The Russell didn't do anything. It just had a dead cat bounce, virtually nothing at all. It just like the IBB rallied a little bit more, of course, but the Russell rallied very, very little. So we're at a real critical level here. Just keep in mind these numbers that Basil talked about, and my numbers are the same. Why we come up with the same numbers, I'm not quite sure, but I know they're valid. But 16,800 in the Dow is the first thing to worry about. That's 38 or 68 points lower than the low we made today, so it would have to be down like 250 points to break that. But one of these days it will break it. Whether it breaks it in one day or takes 2 or 3 days to break it, that should happen, and that will tell you that the trend is finally starting, to roll over. We're seeing some big signs of it already. But, the real key is the trend does not start down until we start breaking previous lows, because that has not happened yet. This market is still in a bullish mode, and today's low was just spot on where it should have been, and nothing has really changed. So until that happens, you can stay long, but once you get below 16,800 in the Dow, then that's when the fireworks should really happen. And when the door opens for the longs to get out, believe me, that corral door is going to be a lot smaller than some of these folks think about. And I worry about these ETFs with the counterparty risk. They really scare me, because I don't know how they're basically, a contract. And, we know that sometimes these contracts are not honored, and then you have some real problems. That's that's one of the things you don't want to even think about, but if it does, we'll see. We have to follow what's happening at the Merck, too, with this class action suit about high-frequency trading and wash trades. We're going to go in more over that with Rich Anderson on Thursday's show. So live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.